One of the biggest mistakes that people make when insuring their family is thinking their savings are enough. And even if they do get a term plan, the next biggest mistake is choosing the wrong one. Now, watch this 8-minute video and trust me, you won't make a wrong choice after this. Better yet, you can watch this in 1.5x speed and save your time. Hi folks, I'm Shashank and this is Ditto Insurance. We speak to people every single day who are either confused about term insurance or have already bought something that doesn't really protect their family the way they thought it would. Now, if you want someone to just look at your situation and tell you, boss, this is fine, this is not, then book a free call with Ditto's advisors. Our advice is free, our services are free. It's a spam-free experience and the link is in the description. Let's talk about the first big mistake. Buying a small cover. A lot of people look at numbers like 25 lakh and 50 lakhs and they feel safe. But take a look at this math. Imagine your family's monthly expense is 50,000. A 50 lakh payout is gone in under 9 years, even without properly adjusting for inflation, emergencies, or medical surprise. Now add kids' education, some health issues, maybe a loan, and that money gets burnt out very much fast. Now at Ditto, we don't just quote a random number. We ask what your family actually spends, how long they'll need support, and what big future expenses are coming, and what liabilities that you're carrying. See, the idea is simple. Your family shouldn't be forced to downgrade their life because you picked a random number that looked big on paper. Now, alternatively, you can check how big a cover you need using our free calculator that we built in-house, which is linked in the description. Now, the second mistake is buying term cover till age 80, 90, or 99 just because the brochure makes it sound like a lifetime safety net. Okay. Think about your life a little realistically. Your kids will be adults by the time you're 60 or 70. Your major loans should ideally be done. Your retirement corpus, investment, and savings should be doing heavy lifting then. Term insurance is for protecting your dependents while they're actually dependent, typically till 60 or maybe 70 at the upper end. Now, when you push the cover all the way up to 99, the premium generally shoots up because the insurer knows that they'll almost certainly have to pay. You end up paying a lot more for a cover you probably don't even need in your 80s. Now, the third mistake is getting return of premium plans. The pitch sounds very tempting, right? Why waste money on insurance, boss? Pay premiums and get all of it back if you survive. But here's what's actually happening. These plans often cost 50 to 100% more than a pure term plan. That's right. And what do you get back? Just your own premiums without any real growth. Now, if you pay 20,000 a year for 30 years, that's 6 lakh rupees. 30 years later, 6 lakh in nominal terms might feel like 1 to 1.5 lakh in today's money because of inflation. So that so-called refund is basically just own money that lost purchasing power. Now, with a pure term plan, you pay a lower premium and get the same life cover. And if you do want something back, probably you should start investing the difference yourself in mutual fund or FD and likely end up with a much bigger corpus. If while listening to this, you're already thinking, boss, I have no clue if my plan is pure term or return of premium or what riders I took, just pause here and book a free call with Ditto's advisors using the link in the description. Heading to the fourth mistake. Now, this is loading your plan with every possible add-ons because trust me, I know it feels safe with all those add-ons, but see, riders like accidental death benefit, hospital cash, critical illness, waiver of premium, disability income, now this list keeps growing. The problem is when you blindly add everything, your premium balloons up and half the riders may be duplicating benefits that you already have. If you already hold a solid health insurance policy, a hospital cash rider may not add meaningful value. If your term cover itself is high enough, an extra accidental death rider might not be necessary. Two riders that usually deserve a serious look are waiver of premium and critical illness. Waiver of premium protects the policy from lapsing if you fall critically ill or disabled and can't pay future premiums. Critical illness gives you a lump sum on diagnosis of serious conditions like cancer or heart diseases, which can plug the gaps health insurance often leaves. Heading to the fifth mistake, and this is the opposite of not buying most important add-ons, and this is the other extreme end. People say, I want only the basic plan, nothing extra. Then life happens, a serious accident, a permanent disability, or a critical illness that can cut off your ability to earn while expenses shoot up. Now, if you don't have riders like waiver of premium, accidental disability, or critical illness, your term plan just sits in the background and you may even struggle to keep it active because, well, you can't pay your premiums. A well-chosen set of riders can turn a basic term plan into a much stronger safety net without adding a massive cost, especially when you focus on the ones that cover income loss situations. The sixth mistake is buying from a very small insurer just because the premium is slightly lower. Now, saving a few hundreds or 1,000 rupees a year feels good today, but the real test is 20 or 30 years later when your family actually has to file a claim. That's when things like claim settlement ratio, solvency ratio, complaint volume, and companies' track record with claims start to matter. A claim settlement ratio consistently above 97% is usually a good sign. A solvency ratio above 1.5 shows the company has enough buffer to pay future claims. A high complaint rate is a clear red flag. You also want insurers who handle decent business volume and have a reputation for not harassing families at claim time. See, you're not just paying for a PDF policy, you're paying for reliability. Remember that. And the seventh mistake is under disclosing your health, habits, or occupation. A lot of people think that they're being smart by forgetting to mention that they smoke occasionally, or that they had a surgery 5 years ago, or that they work in a slightly risky profession. See, the logic is simple. Hide the risk, get a lower premium, but insurer investigate thoroughly when a big claim lands on their table. If they find out that you skipped informing them about smoking, drinking, pre-existing illnesses, or job risks, they have full rights to actually reject the claim on non-disclosure grounds. So years of premiums gone, payment is also gone, your family is left fighting a losing battle. So it's always better to be painfully honest on the proposal form itself. Let the insurer price the risk correctly and issue a clean policy. A slightly higher premium is a small trade-off for a claim that actually gets paid. The eighth mistake is over-relying on your employer's group cover. See, a lot of salaried folks feel relaxed because HR has given them a term cover as a part of their CTC. But group covers are usually small, maybe 10 to 50 lakhs, and they are completely dependent on your job. If you lose the job, or you switch companies, take a break or retire, and the cover disappears. Now imagine, God forbid, there's a recession where you get laid off and suddenly the only life cover you had vanishes overnight. Your personal term policy should be the main pillar for your family. Employer cover is just a bonus. Remember, not the foundation. Okay, the ninth mistake is chasing the lowest premium like it's a discount sale. See, some companies deliberately quote lower premiums to attract customers who filter solely by price on comparison sites. But if that insurer has weaker CSR, poor services, or high complaint ratios, your family pays the real price later when you're not around. Term premiums are fixed for the whole duration. The difference between the absolute lowest and a slightly higher but more reliable insurer is often a few hundred rupees a year. This is spread over 30 years. It's negligible compared to the peace of mind that you get of a smoother claim experience later. So if at this point you're thinking, okay, I clearly don't have the time or patience to check all these ratios and riders, see, that's exactly where Ditto comes in. Book a free call with our advisors. Again, the link is in the description. The 10th mistake is selecting the wrong payout mode. See, people usually focus only on the cover amount and ignore how the money will actually reach the family. For example, if a family needs to close a big home loan quickly, but your plan pays out only monthly income, they might struggle to clear that loan and end up under pressure. On the flip side, if your family isn't used to handling large sum and the entire payout comes in one go, there's a risk that the money gets spent very quickly or mismanaged too quickly. Now, think about your family's behavior. If they're financially savvy or have someone trustworthy to guide them, a lump sum is usually inefficient, and this is what we often recommend because it wipes out big liabilities immediately. If not, a structured income or combination of lump sum plus monthly payout can work out much better. Now, the 11th mistake is letting the policy lapse. Now, term insurance works only if the policy is active, basic stuff, but if you miss your premiums or ignore the reminders and one day your cover simply isn't there. Reviving a lapsed policy can mean extra costs, fresh medical tests, and the risk of rejection if your health has worsened since you first bought it. Years of disciplined payments can be wasted because of a few missed deadlines, so set up an auto debit, treat your term premium like your rent or EMI, non-negotiable. If the money is tight, cutting back somewhere else is still better than leaving your family without a cover. You can also talk to your insurer. They might have something called as a premium holiday. Now, the 12th mistake is buying a term plan and then never revisiting it. See, life won't stay the same for 30 years. You'll get married, have kids, take a home loan, upgrade your lifestyle, maybe start a business as well. But if your term cover is stuck at number you picked when you were 25 and single, that's a problem, my friend. A good thumb rule is to review your cover every 3 to 5 years or whenever something major changes in your life. Sit down with your spouse. look at expenses, loans, goals, and decide whether the cover still reflects your real responsibilities. If not, you can either increase cover with the same insurer if possible or add a second policy. The 13th mistake is not preparing for medical tests. And listen to this carefully. When you apply for term insurance, especially for higher covers, insurers want to see your health reports. If your sugar levels, cholesterol, blood pressure, or liver enzymes are off, you may get a premium loading or in some cases a postponement or rejection. Instead of walking in blind, you can actually get a basic health checkup done before applying. If the reports shows you get a chance to improve your lifestyle, correct what you can and then apply. It's better for your health and better for your premiums as well. A quick tip here, if you have a health insurance, then most of the plans have annual health checkup. You can avail that, get a complete test done, and then show the report to your term insurer. And the 14th mistake is delaying term insurance just because you're young and nothing will happen right now. That's exactly why premiums are cheap at that age. Let me tell you, because the risk is low. Some sample premiums are on your screen. So buying early locks in that lower premium for the entire tenure, even as your responsibilities grow. If you wait till you're 35 or 40 and already have kids and loans, the premium will be higher. Medical scrutiny will be tighter, and any health issue that crops up in between will work against you. See, term insurance is one of those rare products where procrastination directly costs you money. There's also one final mistake, that is ignoring nomination and beneficiary details. See, even if you've bought the right plan, the right cover, paid premiums on time, your family can still face delays and confusion if nominee details are outdated or unclear. If you got married and didn't update the nominee, or if your family doesn't even know where the policy documents are, or if you're divorced and you haven't mentioned the new spouse's name, they'll be screaming at the worst possible time. So have a simple conversation at home. Tell your spouse or primary caregiver where the policy details are kept, who the nominee is, and how to initiate a claim whenever your life situation changes. Example, marriage, kids, divorce, anything significant. So if you're listening to all this and realizing that you've made one or two or more mistakes, that's okay. Most people do. The point of this video is not to scare you, but to make sure that you don't stay stuck in a bad decision for the next 20 to 30 years. Term insurance is supposed to remove stress, not add to it. If you want help figuring out what you've bought or choosing the right term plan, at least from now on, you can book a free call with our advisors. Look, our guidance is free, our services are free, and we don't spam and we don't push random products for commission. The link is in the description. Also, take 15 to 30 minutes, get clarity, and sleep better knowing that your family is actually protected. Alright folks, I will see you in the next video. Until then, happy insurance hunting.